What's going on here exactly? Okay, some countries, of course, have been trying to support their currencies, probably to little effect ultimately. So, Jahangir, where does this leave us?
Look, I mean, on an overall basis, I think we are seeing a rotation of growth from the first half to the second half. So in all of this gloom and doom, we need to concede the fact that, the largest economy in the world, U.S., which tracked about minus 1.2, will probably deliver 1.5% growth on average in the second half. The second largest economy in the world, China, which delivered minus half in the first half of this year. And regardless of your concerns about slowing growth from lockdowns, etc., it is going to be somewhere around 6% on average for the second half of the year. I think where the problem is that the rotation, that the growth drivers of the first half of the year, which is Europe, is probably looking at a recession in the fourth quarter, ending in stretching into the first quarter of next year, and emerging market ex-China. And there, I think, much of the concern is in Latin America and EMEA, which is will now have to face the brunt of the significant amount of monetary tightening that they did starting from the second half of the year. And I think that, in all of this, I think people are forgetting that the first and the second largest economy in the world are actually going to perform better in the second half of the year than the first half of the year. That doesn't really help us very much, because that also means that the largest economy in the world will continue to raise rates and keep financial conditions very, very tight, or even tighter from where we are.
So what does it mean, I guess, you did a half and half comparison there. What does it look next year, for example? Do you think 2023 globally will look a lot slower than already what 2022 looks like?
In general, it should be, but again, much will depend upon how, big the recession fears are and how much do they realize in Europe. I think that's the key, that if Europe actually manages to get away with a mild winter, with less, rationing, and with the kind of fiscal support, and therefore the recession is shallow, I think that, in 2023, global growth is not going to look as bad. But on the other hand, if those recession risks, actually get realized, then we are in trouble. But more importantly, I think it also depends on how quickly or when does the Fed tightening start impacting both labor market in the U.S. and slowing down the economy. We still haven't seen that, and I think those are the two factors that I think is going to drive 23. Our sense is that 23 probably is going to still be a subpar growth, but fears of impending collapse and a complete implosion in the global economy, I think we still have to wait for some more time if it actually happens.
You're not going to stick your neck out on that one, are you, Jahangir? Okay, Jahangir, give us a sense of how this whole tightening of policy in the US is playing out in EM. I mean, it's obvious that many central banks have had to raise rates, protecting their currency, which then produces this negative feedback loop of them slowing their own economies down as well. And this is not really at the moment ideal. Now, if you are a proponent of a strong dollar, how long does it continue for, and how much pain does this inflict on EM?
I think that's the key. I think more than where the Fed funds rate go, apart from a few countries like Mexico, etc., where their monetary policy is very closely tied to the Fed funds rate, most other emerging market economies aren't really that closely tied to the Fed funds rate, except when it hits the dollar. I think it's the dollar strength that drives emerging market central banks' thinking more than just the Fed funds rate. And I think in that aspect, I think if you look at the Latin American economies, and let's say barring Hungary, if you look at the Central European emerging market economies, they already have tightened quite a bit. They've already paid the price and bowed down to dollar strength in terms of letting the currencies depreciate. So much of the adjustment is over there. So even if growth is going to slow over there, and clearly it will because of the impact of the monetary tightening, I think as far as asset markets are concerned, fears of another big leg down in exchange rates or a big leg up in rates, those are probably a bit far-fetched at this point in time. On the other hand, if you look at this time zone, I'm speaking from Singapore in Asia, I think those are the ones that so far have defied dollar strength, and I think they haven't adjusted as much. And I think going forward, it is the Asian economies, particularly the recalcitrant, high yielders, that will, I'm thinking about India and Philippines over here, and probably even Thailand I'll put in the mix. Those will have to bear the brunt of the adjustment going forward.
Jahangir, let's flip that question around and see if we had a big leg down for the dollar. That may well start, actually, then importing inflation from the rest of the world because, of course, inflation, the U.S. has a big trade deficit. That could be exacerbating inflation as goods will become more expensive in dollar terms. So that could then create this other feedback loop, which is higher interest rates in the U.S., which could have all sorts of repercussions.
Look, I mean, we are obviously in very uncharted territories. 10, 12 years, we've had zero interest rate. The regime has shifted. People are struggling to get used to this new regime, not just of, rate cycle, but also of the process of inflation expectations have moved up, and clearly the dollar and how it affects, for example, commodity prices on one hand, and how it affects exchange rates in emerging market economies are clearly important aspects of it. I would point out that the fact that the dollar is so strong has actually dampened down commodity price movement. So it isn't that the emerging market countries are facing all negative shocks from the higher dollar. I mean, on the net basis, it is a bad thing for emerging market economies. But at least on the commodity front, they're getting some relief because commodity prices are being kept down simply because the dollar is so strong at this point in time.
Final question. I mean, when you look at where nominal exchange rates are, it's easy to make a headline out of dollar Philippine 60, dollar ringgit 450, dollar baht 2004 lows. Do you think we'll see a lot more weakness in those currencies? And is it going to be a problem? Is it going to be a big disturbance to those economies? That's the other part of the question.
Right. So I think the disturbance that comes about is when you sort of defy and go against whatever the fundamental strength is, right? And then you build up these expectations of a very disruptive, one-time, forced move in these exchange rates. I think allowing the exchanges to adjust in a orderly fashion, I think, is probably the best thing for these currencies to do. And in that case, the markets get used to it. I'm not saying that there are no negative effects that are indifferent, but the disruptive effect on capital flows, etc., that gets much lessened. I think using FX reserves to sort of stem against the trend rather than just smoothing out volatility, I think that's what gets emerging markets into trouble. And a few of the Asian economies have been following that process, and I think that's where the chances of a disruptive exchange rate adjustment forced by market is becoming bigger and bigger.